What is appreciation, and how does a building become worth more without anyone lifting a finger? Appreciation is simply the increase in a property's value over time measured from purchase to today. There are two main kinds, market appreciation and forced appreciation, and they work very differently. Market appreciation happens passively as overall demand rises, rents grow, or cap rates compress in the area. It's driven by outside forces, the economy, population growth, and investor demand for real estate generally. Forced appreciation happens actively through improvements the owner makes to boost the property's income. Raising rents to market level, cutting expenses, or releasing vacant space are all forms of forced appreciation. Because value is often based on income divided by cap rate, boosting income directly boosts the property's value. A single-tenant triple-net property has less room for forced appreciation since the tenant controls most operations. Its appreciation instead often comes from market cap rate compression or the tenant's improving credit over time. Appreciation isn't guaranteed. Markets can also depreciate if demand falls or cap rates expand. Total return combines both appreciation and the cash flow collected along the way, not just one or the other. Some investors chase appreciation aggressively through value-add deals, accepting more risk for more forced upside. Others prefer the slower, steadier appreciation of a stable triple-net asset alongside reliable income. So appreciation is value earned two ways: markets lifting the tide, or owners actively creating it themselves. This is educational, not investment advice. Always consult a qualified professional.